Welcome to Fintech CTO Talks, the podcast that goes behind the scenes with the tech leaders solving the challenges and rewriting the rules of finance. Money moves fast. Does fintech keep up? Let's find out. I am Ami. On this episode, I sit down with different CTOs, engineers, innovators who are making finance faster, smarter, and more connected. Together, we'll explore the platform, the code, and the bold ideas shaping the future of financial technology. And yes, making it a little fun on the way. On today's podcast, we have been joined by Benjamin Ensor. He's the director of research and strategy at 11FS, where he focuses on building digital financial services that create more value for customers. He's a seasoned strategy leader. Benjamin brings over 3 decades of experience advising financial services for firms across the globe. He has worked extensively across retail payments, bankings, investment management, and insurance, helping organizations navigate shifting customer behaviors, evolving market dynamics, and growing impact of digital technologies on business strategy. There is a lot of introduction for Benjamin. Benjamin, welcome to the podcast.
That was a long introduction. Thank you so much, Ami, for inviting me to join you. It's a great pleasure to be with you.
Absolutely. So today he would be talking about embedded finances and how, the people never knew the bank left. So my first question, Benjamin, to you is, the global embedded finance market was valued. I want to talk numbers in my first question to you, and then we can jump from there. So, the global embedded finance market was valued at around $83 million in 2023, according to a report. And it is projected to reach over to more than $170 billion by 2033. So, that's a nearly 7%, 7x jump in a decade. So when you look at numbers, from a research perspective, a research chair sitting there, does it feel right or does it feel accurate? Reflection, from your reflection that actually is it happening on ground or still there are gaps and what is the customer reality?
Yeah, it does fit. It does make sense. I think the reason is there's a really compelling logic to embedding payments, financing, and insurance into other platforms and experiences, right? For the brands that are leading those other experiences, whether those brands are airlines or taxi companies or retailers, or even, frankly, shipping operators, adding finance and insurance into their platforms can make things easier, cheaper, faster, better for their customers. For the financial services firms powering those services, it can be a new way to reach customers. So particularly for maybe smaller financial providers or financial providers in smaller countries and so on, this can be a great way to reach new audiences in a more convenient way for them. And of course, for customers, that can often just make it cheaper, faster, or better for them. So there are many scenarios in which everybody wins from embedded finance. And I think that is why we're seeing it grow so strongly, is digital technology enables firms to build just simply better experiences for customers. And embedded finance is a great example of dozens of ways in which firms are building better experiences.
Okay. So when you talk about, that as a customer, you never, the bank never knew that we left them. So from your years of watching financial services evolve, from your first organization till now. So is it a sharp end of fintech strategy? And when did you first sense that customers were quietly drifting away from their banks without, without sounding alarm, basically?
That's such a great question because it is this sort of slow, silent shift. And I think a lot of established banks, a lot of traditional banks didn't understand what was going on, didn't see what was happening, and went through a sort of stage almost of denial that this was actually happening. But it started to become clear about say somewhere around sort of 2015 or so, that customers were starting to move money, particularly out of their bank accounts, into payments accounts. Firstly at firms like PayPal, later firms like sort of Revolut and Wise and so on. And they were not just moving the money out, they were then holding it there. And of course, that's only accelerated since. But the alarm was really sounded very clearly for anybody who was sort of listening or watching by what was happening in China. So back in 2013 or 2014, Alibaba, now part of now Ant Financial, launched a mutual fund called Yue Bao. And within 8 months, that had attracted 81 million customers and $81 billion in deposits, making it China's largest mutual fund, and it's now actually the largest money market fund in the world. And I realize talking to an Indian, 81 million people doesn't sound like that many. But of course, 81 million is a huge number of people.
Huge numbers.
Um, and we also saw other developments in China. So we saw WeBank, which is partly owned by WeChat operator Tencent, and MyBank, owned by Alibaba, starting to report really astonishing growth. Right? What WeBank was doing was using artificial intelligence and machine learning to do things like determine credit risk and offer microloans to hundreds of millions of Chinese consumers and small and medium-sized businesses that had little or no sort of traditional credit history and therefore were completely underserved by the traditional, and I should probably say, formerly communist banks. Um, and this, using AI and machine learning back in 2015 was revolutionary. Now, you sort of take it for granted. Well, of course, everyone's doing that. Um, and of course, you can argue that China was special, and of course, China is special. But the fundamental needs of Chinese consumers and businesses are not different from those of consumers and businesses anywhere else in the rest of the world. So this has really been going on for well over a decade, and the signs have been there for anybody who's watching that new platforms with strong customer relationships can distribute financial products, and we've seen that happening across Asia, across Africa, Latin America, all around the world.
So when you're talking about this, like, should we look at embedded finance as it's one thing only, it's a separate thing, or like, or where does open banking end and embedded finance actually begin? Is there a clean line between it, or still it is a blurry spectrum?
Yeah, so firstly, embedded finance is obviously a bit of a catch-all for embedded insurance, embedded investments, embedded sort of banking, embedded payments, and so on. Underneath there's all sorts of different use cases. Open banking is a bit different. I mean, open banking has mostly been used to sort of read information and do things like initiate pay by bank payments. Embedded finance, by contrast, is the integration of financial services such as credit, insurance, or payments into other non-financial products, services, or experiences. Ideally, sort of at the point of customer need. So as you're checking out, as you're booking a flight or you're booking a car hire, it says, "Well, do you want insurance with that?" or whatever. In a way that sort of enhances or potentially even transforms the original value proposition. Right? It's easy to forget that you need the travel insurance or whatever. So having it bundled in creates that better experience. Um, Whereas open banking and I suppose open finance more widely is primarily a way of providing access to customer data that becomes a building block for other services,
Yeah.
where embedded finance is actually about integrating those financial capabilities into other products. So there is an overlap because open banking can be used to sort of integrate banking data into other platforms, something like an accounting software platform, and so on. But I'd say open finance and embedded finance are really different things. And I'd say there is quite a clear distinction between them, even though open finance and open banking can be used as a capability that sits beneath embedded finance.
Okay. So when we are talking about a study by JD Powers of 2023 retail banking, so they found that 13% of bank customers say that they'll probably switch bank into, next 12 months or a year. But just up to 5% actually switched. And that's the data of 2018 and 24. So like, but switching is, it can be dramatic, it is visible. So the more dangerous story of bank is surely, the quieter migration of customers, not closing accounts, but silently routing their financial moments, like, to Shopify or to Uber, to Amazon Money. So how do you distinguish that slow, invisible change which is happening and the numbers are also switching?
Yeah, that's such a great question. And it sort of comes back to the point you were making earlier about, the bank doesn't realize the customers has left. Um, yeah, bank account switching is increasing in many countries. It's also becoming more common for people to operate multiple bank accounts. Um, it does matter what fees customers have to pay, right? So the higher the fees you pay you pay on a bank account, the more likely you are to close your old account, right? So in markets where customers are paying very low fees or no fees, they'll just leave the account open. If, on the other hand, you're having to pay, I don't know, $5 or $10 a month for your account, well, people are much quicker then to shut those down. So it varies a little bit, but your fundamental point is that in many countries, established banks are losing the relationship but keeping the account. Um, I remember back in about 2015 when I was still at Forrester, some of our smartest clients there, um, there were some people at ING, some people at Allied Irish Banks, and so on, who'd worked that out that this was happening, and they were monitoring it. They were monitoring it and reporting it on a monthly basis. How much money was being moved out every month into PayPal, into Revolut, into all of these, these sort of fintech disruptors. Um, so to understand what's happening, banks and insurance companies and so on really need better. It's mostly a problem actually for banks. You need better metrics than just the number of accounts that you have. You really need to be measuring engagement, loyalty, estimate customer value. You need to be looking at the balances in accounts. You need to be looking at the transaction volumes. Because if you're just measuring the number of accounts, yeah, you can lose sight of the fact that you've lost the relationship, but you're still paying the cost of administering the account.
Absolutely. So when you're talking about this, like there are still consumers, who still trust the bank to deliver regulated financial services. But there is a nearly half of there are half of people who are like trusting the super apps, the e-commerce platforms, even telecom providers to deliver those same services. So is the invest like what does it tell you about how far to trust, or the advantages, or how banks are changing in this coming decade?
Yeah. I mean, of course, people are absolutely right to trust banks to deliver regulated financial services. Banks are very good at that, and um, banks broadly are very, very trustworthy. I mean, we do have the odd bank collapse and so on, but generally, the banking systems in most countries are quite well robust, and the regulators have put in place sort of insurance schemes and so on to try and protect account holders in the event that there is a problem, which does happen periodically. But of course, trust is more about it is about more than just is my money safe. There are many other dimensions to trust. Trust is actually really quite complex because all these different dimensions are sort of integrity, competence, transparency. The word trust actually encompasses a number of other things that we don't necessarily think about, but are actually there as part of our decisions. And of course, what happens is people trust brands that they are familiar with and have had good experiences with. And so over time and over generations, people start trusting different brands. If you look at younger people in any country, the brands that they've grown up with are different to the brands that their parents grew up with, and therefore they trust different brands. And of course, what we've seen over the last 20 years is spectacular growth of technology brands providing all sorts of weird and wonderful, amazing services like the super apps and so on, and e-commerce and so on. And naturally, people trust those brands. And for younger people in particular, well, they're much more familiar with those brands than they are with the bank their parents bank with
Correct.
or the insurance company their parents deal with. So when they come to think about their finances, well, why wouldn't they be open to it? So I think the really interesting question is really thinking about, well, what are the components of trust and why should customers do business with us, right? So, do most people in most countries trust banks to keep their money safe? Absolutely, yes. But do most people trust banks to help them make the best financial decisions or trust them to be benevolent and look after their interests? Well, maybe, maybe not. So I think if you're a bank, you're listening to this, what value are you creating for your customers? Why should your customers trust you? What is your customer proposition? Why should they bank with you?
Correct. like this is one thing which I am facing. You're like, it is out of the way. Like when I visit a bank, a government bank here in India, there are no youngsters there. It's like there are people 55, 60 plus. So what does that also say? Like, is it happening in other countries? And is that true? Or it's just limited to here because we have quick commerce, we have Google Pay. So how like what is that?
It's
What does
it's
that
it's
say?
it's absolutely not an Indian trend. I mean, I go into bank branches out of professional interest, but I haven't personally used a bank branch for 15 plus years, and even then was, because my auntie sent me a paper check, um, but I think, so I think what you were describing is absolutely right. There are young people are not using branches anywhere around the world, and actually you end up with a little bit of a social challenge where you've got isolated older people in some countries, going to the bank branch because it's one of the few places they can get human contact. So,
Correct.
it creates some sort of very interesting social challenges that, banks were never set up to be sort of social care centers, but actually older people sometimes go to the branches because that's someone to talk to. Um, but what it also signals is, banks generally have failed to transform their branches from transaction centers, where you used to deposit cash, notes, and coins, into places where you might get financial advice, right? So why should younger people go to bank branches?
Correct.
There's not really a pull. And by the way, it turns out sometimes, young people actually don't always like talking to people because
Hmm.
they'd rather work it out for themselves first anyway. So there's also, that dimension.
True. Like you were talking about integrity, like you have spoken about brands integrating bank capabilities, creating new value at a point for the need of the customer. So which sectors are doing a exceptional and a tremendous good job right now, and which are the ones which are not growing with the time?
Well, where do we start, right? I mean, I mean, there's so much embedded finance. You start to take it for granted. I mean, the most obvious example is sort of in-app payments, like sort of Uber, Grab, Shopee, Gojek, Lyft, Airbnb. Name your favorite um, platform, where you get into an Uber or you Grab or whatever. You hitch a ride, and you get to your destination, you don't actually do the payment. The payment just happens in the background. It's just invisible. It's so embedded you don't even do it consciously. But then you've got buy now, pay later services, things like Klarna and Afterpay. You've got point of sale installment loans. You've Affirm, Split it, dozens. You've got platforms like Shopify and Amazon that are offering working capital loans directly to the merchants on that platform. I mentioned earlier, we talked about sort of embedded travel insurance, where everything from travel platforms like, I don't know, Expedia or Booking.com or Scanner, or airlines like AirAsia, um, or Grab, again, embedding the sort of trip insurance and the
Hmm.
travel insurance directly into the booking process. Um, you've got financing for marketplaces, and so the businesses selling on digital marketplaces like Shopee and so on, often getting financing from the marketplaces. And we talked earlier about embedded investments like UA Bao, but there's dozens now of others. I mean, embedded investments was probably one of the slowest to get started because it doesn't really make sense to embed investments into an airline, or into travel or retail, but it
Hmm.
does
Hmm.
make sense to embed investments into banking and
Hmm.
payments. And so that's where we're starting to see that take off. I think the areas where it's been slowest has been particularly on some of the sort of B2B, business to business opportunities where it's technically much more difficult. So there's things like supply chain financing. There's some really interesting stuff happening in markets like Indonesia and so on, or trade financing. So you're a manufacturer, maybe you're based in Europe or North America, but you're getting some manufacturing done in China or elsewhere in Asia, and you're shipping goods halfway around the world. Well, the financing and the insurance for that is quite complicated. And because it's quite complicated, it's taken much longer to for those kinds of opportunities to become embedded. Sometimes it's down to the data of being able to get good standardized data, so that you can actually build that into platforms. So I think where it hasn't made as much progress is where it's just technically more difficult to do because the data isn't there. It's fundamentally just more complicated, right? Moving a shipping container halfway around the world is just more complicated than paying for a taxi, or whatever it might be.
Correct. There is a report of Alloys of 2024. It says that 75% of sponsor banks lost tremendous amount of money, like to compliance violations in their embedded finance partnerships. And 80% of that report is saying that there is difficulty meeting the compliance requirements. So when we see these numbers, like, does it suggest that the industry built the revenue model before it is building the accountability, or how is it?
Yeah, I mean, I think you're right. The finding in that Allo report was pretty striking. I think it's worth pointing out that that report was focused on the United States, and that some of the findings don't necessarily apply to other countries around the world, though the warnings obviously do. Because the American market evolved differently to most other markets around the world for a couple of big reasons. Firstly, it was, and to some extent still is, extremely difficult to get a US bank charter or bank license. And that's made it hard for even large and successful fintechs to become licensed regulated banks. And then, secondly, there's an amendment called the Durbin Amendment to the Dodd-Frank Act that was passed after the global financial crisis, which limits US debit card interchange fees. But there's a well-intentioned amendment that doesn't apply to banks with less than 10 billion in assets, which was intended to protect sort of smaller community banks and credit unions and so on. But that in turn makes those smaller banks and credit unions attractive partners for brands that want to issue cards because they can earn a higher card interchange fee. So if you're a fintech and your whole business model depends on card interchange fees, well, you want to partner with one of these smaller banks because they can pay you a higher interchange. Unfortunately, these smaller banks and credit unions often lack the scale, the staff, the sophistication to manage complex, bank as a service operations. And so, just as an aside, there are many large banks that have been fined for money laundering, anti-money laundering, sorry, not money laundering, anti-money laundering failures, or sanctions monitoring failures, and so on. So that it's not only the smaller banks, but smaller banks have struggled. So what you ended up with in the States was this emergence of this new layer of intermediaries, the banking as a service providers, firms like Bond and Unit, to manage the relationships with the brands and the smaller banks. In principle, there's nothing wrong with having this additional layer of intermediaries, but in practice, it made these operations more complex and sometimes less transparent. We didn't really see that happening in other markets, or we haven't seen that happening in other markets to anything like the same extent, because actually the firms providing banking or insurance as a service were usually regulated banks or insurance companies. So America had a sort of slightly special mess all of its own making, but but the principles and the warnings from that absolutely do apply to other countries. So I think you're right. The people were focused on the revenue model and not on the accountability model. So I agree with you.
Okay. And the second part of this continuing question is, like, it might be a uncomfortable question. Like, in embedded finance, who is actually responsible if something goes wrong?
I think it's I think the regulations in most countries are fairly clear cut. The bank is responsible or the insurance company is responsible. That's why banks are licensed to hold customers' deposits and lend money, and other organizations are not. Um, when you look at some of the incidents where it's gone wrong, like the Synapse collapse, where
Synapse, yes.
yeah, exactly. They lost somewhere between 65 million and 95 million dollars, and 100,000 people have been locked out of their money. Um, and this was partly, just a failure of basic record keeping and accounting that Synapse failed to keep track of the money. It also turned out that Synapse had been sort of commingling end users' funds, its own funds in accounts, really complicating the process of reconciling where the money was. But to lose track of $40 million or whatever, it's quite an impressive achievement. But there's also a sort of failure of regulation. I mean, America is a huge market with, I realize not compared with India, but it is a huge market. with numerous regulators, including both at a state and a federal level. And Synapse sort of slipped through the gaps in those regulators' jurisdictions. The Federal Reserve wasn't responsible because Synapse wasn't a bank. The bank didn't fail. The middle failed. And so,
Middle
the
layer.
really unfortunate thing is, customers thought their money was insured by the Federal Deposit Insurance Corporation because they were clearly told that it was, only to discover in practice that it wasn't. Um, so, the accountability here really was on the underlying bank. They should have known. There were warning signs. The underlying bank, like Evolve Bank, should have known what was going wrong at Synapse. And obviously, the executives at Synapse failed to keep adequate regulation. The really sad thing about that story is it hasn't been resolved. Nobody has
Exactly.
actually dug into, well, what actually happened. I'm sorry,
Correct.
people who dug into it, nobody has got to a conclusion of where did that money go? $40 million doesn't, or $50 million doesn't just disappear. Where did it go?
Correct. So, like from a research perspective, how do you frame a triangle between, the accountability, the embedded finance, the companies or the banks? How do you draw that? How does that work?
I think the underlying banks have to be responsible for the financial products, right? So if there's a bank that is lending money, or there's a bank that's processing a payment, or a bank that's holding a savings, or there's an investment firm holding, again, customers' investments, those firms have to be responsible for that. Um, and that has to be very clear. And the brands need to provide them with the right information. They need to introduce them to customers. They can maybe manage the customer relationship, but ultimately, the regulated firms are responsible for the regulated products.
Correct. So when we're talking about lending products, McKinsey projects by 2033, embedded finance could account to 20 to 25% of total lending revenue. It is globally. So lending is the most sensitive product. It's where actually people get hurt. So given the BNPL mis-selling we have already seen, is this that the industry building embedded lending responsible, or quietly repeating the mistakes of the 2008 credit cycle? Or is it way worse? Or you cannot still see it. What is it?
I'm not sure I agree that lending is the most sensitive product. I mean, we were just talking about Synapse, right? And it's the depositors, not the borrowers,
Hmm.
the various brands that work with Synapse who've lost their money. But I do agree with you that the borrowers can get badly hurt by irresponsible lending. So, I think your wider point is absolutely right. Um, it's really, really difficult, maybe impossible, to generalize about an industry as a whole, particularly on a sort of
Correct.
global level. Because you've got both a majority of companies that are lending responsibly and a minority that, for a range of reasons, are knowingly or unknowingly repeating the types of aggressive, careless lending that led to the global financial crisis, right? You always get people in this industry and every industry who are trying to get rich quick, and they will try and cut corners and they will try and dodge regulations, find ways of getting things done. And sometimes, that's a good thing because it leads to innovation. And sometimes it's a bad thing because you've got people who don't know what they're doing, or people who do know what they're doing and are deliberately hiding, obscuring, stealing. Um, so, so it's a really tricky question. I think that, what the regulators have to do, and the regulators have a really tough job, is look out for patterns of where is somebody growing really, really fast? Where are we seeing an explosion in credit? Right now there's talk about lots of problems in the private credit markets, where you've got, again, these slightly hidden, less transparent markets where it's not clear what's going on. And I think you're exactly right. It's these sort of hidden corners of the market where problems build up. And there are people who've got an incentive for whatever reason, just achieving their own targets, achieving their own bonus, of encouraging the growth of these things. And they think they're doing really well, and maybe they are personally doing very well, but they're actually creating systemic problems. And it's really tough for the regulators to find that. But that's their job, is to figure out where are those dark corners where people are doing bad things.
Correct. So, like when we talk about this, the FDIC's formal enforcement actions also have been directed, at sponsor banks involved in embedded finance partnerships. So, is this regulatory pressure actually cleaning up the industry, or is it pushing riskier agreements or arrangements into the corners?
I think it is really helping to sort of clear up the industry because it's making it absolutely clear, that banks are responsible for making sure they understand what's going on in these kind of fintech lending programs. Actually, just as a bit of an aside, um, some of this, there's some of these sort of catastrophes and so on are really nothing to do with embedded finance, right? These were fintechs creating, financial propositions. This wasn't actually being embedded into anything else. It wasn't being embedded into retail or travel or anything like that. It was pure sort of financial things. But no, I think to your point, I think the actions by the FDIC and the Federal Reserve and other regulators in the States are indeed um, bringing back the kind of discipline that should have been there all the way along, and really looking into that. But of course, there are other areas that are unregulated or poorly regulated. I mean, let's not start on crypto, but if you want to find an area where there's all sorts of weird stuff going on,
Correct.
look at crypto, look at meme coins. I mean, there's just rampant abuse
Um,
going on, involving, people who are presidents of countries and stuff. So, there are some
Correct.
bigger and unfortunately politically protected issues. Um, But the regulators can only do what they have the mandate to do.
True. So like there is a trend which which we can see is that there are customers who prefer a single app for all their banking needs, but like that is for an average consumer already there. So like is there a gap between what people say what they want to do and what they actually do? Like from your years of experience, your years of research, and what you have observed, do you believe that can it still close the gap, and it can just reclaim the financial relationship? Like how is it?
Yeah. I spend a lot of time doing customer research, and there's always a big gap between what people want to do and what they can actually do, and there's a big gap between what they say they will do and what they do for all sorts of human reasons. Um, but I think the other point here is, different apps do different things, right? It's very hard for any one company to do many different things well. So, in different countries around the world, we all build our own sort of personal financial ecosystems, right? We pick the providers and apps that best suit our own financial needs and situations. And yes, that often results in many of us using multiple financial services, just as we use, multiple communication services, multiple media, travel, retail, etc. And of course, it would be more convenient to have everything in one app. Um, Though actually, the convenience of having everything on one device is pretty great, but we kind of take it for granted now. But that didn't exist 20 years ago, 15 years ago, right? Um, but I suppose then the next question is actually, do you as a consumer want all of your eggs in one basket, right? Is that actually a good thing? What happens if something goes wrong, right? I mean, we've had plenty of situations over the last decade where financial firms all around the world have got into trouble for one reason or another. But if all of your finances are with that firm, if you've only got one payment card in your wallet and you only got
Correct.
one account, well, what happens if something goes wrong? So it's actually quite good to have a backup and have, you know, a bit of diversification in how you manage your finances.
Okay.
I think
What
there was a second part to your question, wasn't there?
like what like according to you, is it possible to reclaim this financial relationship with the customer? That was the second part.
I think a lot of banks lost sight of how they were creating value for customers. I think some people in traditional banks thought they were providing value by acting as a store of money, which has been completely commoditized, and they see their businesses primarily as lending, and that's fine. If you want to be a lender, go for it. There's a good business in lending, um, but they didn't really look at the wider financial needs of their customers. What many customers want is financial advice, financial guidance. Help me make better decisions about my life. Help me enjoy doing the things I want to do. Um, and a lot of banks completely ignored that opportunity. And that's why we've seen all these fintechs and other firms moving into that gap. Um, and one of the other problems is banks have often end up being manufacturers, right? They're manufacturers of credit, which is, a big and important and complex business. What they're not often very good at is sort of managing, helping people manage finance and really sort of retailing and thinking about for individual customers, whether those are businesses or consumers, how can we help that customer that make better financial decisions? How can we be more of a like a retailer, providing financial advice, guidance, and so on? And that's the opportunity for banks. And that's the opportunity that's being taken away by other brands that have got a better understanding of who customers are and what customers need.
Absolutely. One last question, Benjamin, is with AI into picture today, how do you see and what do you see what will evolve in 2023 into the embedded finance space?
I mean, it's interesting because AI, of course, particularly sort of conversational AI and agentic AI, creates huge opportunities to do some of the things I was just talking about better, like giving people more personalized, more tailored financial guidance and so on, can be done or can start to be done with a sort of conversational and generative AI in a way that's very difficult to do beforehand, other than having a human sort of doing it. Um, and then when you get into some of those more complex areas of embedded finance that I was talking about earlier, like sort of trade finance and so on, often the problems are like reconciliation, right? You're a big merchant, you're selling all around the world, right? You've got all these payments coming in, and you're trying to reconcile those payments, what's arrived against, orders that are going out. You're trying to manage multiple currencies and so on. Um, Agentic AI offers fantastic opportunities to automate, streamline a lot of those processes. So there's a real race on to figure out how do we make those things better and easier for both companies and consumers. Um, so I think we're going to start seeing, yeah, AI being embedded into these embedded finance propositions. Absolutely.
Perfect. We will move on to the next segment of the podcast. That's the rapid fire round. I'll ask you a
Fantastic.
few, I'll ask you a few questions, but you'll have to be very quick in answering.
Okay.
Okay. One word to describe embedded finance.
Embedded.
Payments, lending, or insurance. Pick your favorite embedded play.
Insurance, because it's easy to overlook, but
Okay.
needed.
Okay. First app that comes to your mind doing embedded finance right. Perfect.
Oh, probably Grab.
Mm. Buy now, pay later. Is it genius or dangerous?
Dangerous. Too attractive for young people.
Correct. Would you rather build for banks or for startups?
Startups are faster and more fun.
Okay. API first or customer first? What wins?
Always customer first, but it's a false question because if your customers are developers, then it's API first, right? So customer first.
Cashless world, exciting or scary?
Scary. If the power network goes down, you're stuck.
You're stuck. Super apps, future or fad?
Half of Asia. Future.
Okay, one last one. If you had to explain embedded finance to a 10-year-old in one line.
It's like how you buy stuff in Minecraft.
Haha, that's a nice one. Everyone loves Minecraft. Okay, we'll move on to the next segment. There's one question where you'll have to answer that into 30 seconds. What is the role of AI into embedded finance in the present year?
We'll see AI streamlining um, decisions and taking work away from customers, helping them make choices faster.
Perfect. Thank you, Benjamin, for your time and had a really great conversation with you today.
Ami, it's been a great pleasure. Thank you.
So, everyone, let's stay connected as we continue to explore and understand the evolving world of financial technology. Please share this episode with everyone who loves finance and tech. Let's keep the conversation going. That was Benjamin sharing his insights. We'll meet in the next episode. Until then, stay curious, stay inspired, and keep exploring.